Welcome back. We have breaking news this morning. The U.S. reportedly clearing a deal for the sale of NVIDIA's H200 chips to at least 10 Chinese companies. CEO Jensen Huang, of course, in Beijing with President Trump right now, along with a dozen-plus other CEOs trying to open up markets in China with the president. Markets are reacting to the president's historic trip. Stocks are higher across the board, and we are now at the highs of the morning. Take a look. Earnings driving the situation as well. Dow Industrials up 418 points, almost 1%. The S&P and the Nasdaq are both trading higher and further into record territory. Both indices yesterday hitting all-time highs as money moves into tech as well as the broader economy. This morning, President Trump officially invited Xi Jinping to the White House on September 24th. As he made remarks from the podium, Taiwan has been a major point of discussion, really underlying the tensions between the two countries. Xi Jinping said that the issue around Taiwan could lead to further conflict with the United States if the issue is not handled properly. That Taiwan independence and cross-strait peace are as irreconcilable as fire and water, said Xi Jinping. He said if it is not handled properly, it will lead to a, quote, dangerous situation, a veiled threat from Xi Jinping. Meanwhile, yesterday, the S&P 500 and the Nasdaq hit all-time highs at the close, driven by big tech, despite the hotter-than-expected April PPI number. Joining me now is MacroMavens President Stephanie Pomboy. Stephanie, great to see you. We got a rally underway, and I know that partly this is earnings, but I want to get your take on what Kevin Hassett told me on Sunday about the economy. Watch. What kind of economic growth number would you expect for 26 and beyond then? Let's assume that we do get out of this war fairly soon. What kind of GDP growth number would you expect for the U.S. economy?
If you look at how fast the capital stock is growing, that's sort of like how much stuff that we make stuff with. It's between 5 and 8% right now. If you divide that by 3, that's about how much GDP growth you get out of just capital spending. We've got productivity growth at 2.5. I think we really could be looking at numbers north of 4, north of 5, north of even 6, because there's so much capital stock growth right now. Remember that the 2% number that you saw for GDP growth, the reason why it was 2% and not 4 or 5% was that we imported a record number of capital goods because we're building all these factories. Once we turn those factories on, you're going to see really growth unlike anything we've seen before.
Wow, and that's with oil prices at $100 a barrel. Stephanie, your reaction?
Well, I think obviously we've seen a real boom in CapEx spending, which has been great because the consumer has really been kind of a status quo in kind of muddling along here. And I guess the question is, that is history. What happens going forward? He seems to have a very sanguine view, and I would be more inclined to share it if we weren't watching the entire interest rate complex move higher. You know, we've seen long rates obviously moving higher, not just here, but globally. And then this week, for the first time since 2023, the futures market is pricing in Fed rate hikes. We have switched from anticipating cuts over the next several months or a year to actually looking for some modest tightening. And I think that's a huge story because we have, as you and I have talked about many times before, a massive amount of corporate debt that rolls. And we also, to fund all this AI expenditure, are increasingly relying on debt. You know, all these companies that were cash cows have burned through their free cash flow to fund this AI expenditure. So the path of interest rates is going to be crucial to that long-term growth forecast.
Which is why we're waiting on Kevin Warsh, and I want to get some clarity there. We're waiting on breaking news right now, Stephanie. April retail sales coming out, jobless claims coming out, and the estimates call for a gain of 0.5% in consumer spending. We want to get those numbers right away because this market is holding on to triple-digit gains with the Dow Industrials up 396. The jobless claims coming in a little hotter than expected. Cheryl Casoni has all the numbers now. Cheryl.
All right, yeah, but we're going through a few numbers here. Let me start with the April retail sales number. You know, Stephanie was just talking about the consumer retail sales for the month of April. The expectation was 0.5% to the upside. We got that right in line. Ex auto 0.7% higher. The estimate was 0.6%, and then the core retail sales numbers coming in a little bit better than expected, 0.5%. 4.9% retail year over year, 4.9% year over year for retail sales. So again, back to that consumer, the strength of the consumer. Initial claims, you mentioned this, Maria, a little bit higher than expected, 211,000. We were looking for 205,000, 1.782 million on continuing, which is just shy of the 1.79 million that we were looking at, to be clear. Also, as far as the import-export story, I want to get to this because import prices, we were looking for a gain month-to-month of 1%. We got 1.9% on that read. And then export prices month-to-month, we were looking for 1.1%. We got 1.3%. So, but again, yeah, holding on again to this incredible rally, Maria, that we're seeing. Back over to you.
Yeah, I mean, the retail sales number here year over year is a solid number. Stephanie, your reaction to these numbers?
Well, again, retail sales is not deflated for prices. So if you actually look at the month of April, we had a 0.5 gain in retail sales and a 0.6 gain in inflation. So in a real basis, we had a net decline. And this has been the story for a while. This isn't some new dynamic. Basically, since 2020, with the big inflation spike, ever since then, consumers have been buying the same number of units. If you look at the retail sales index divided by the CPI index, what you find is it's moved straight sideways. So basically, they're just buying the same number of units. They're trying to sustain the same consumption level, but they're paying more to do so. And right now, they have the capacity to do that in large part because they're getting the tax refund support. So that's been helpful to sustain retail sales. What I'm concerned about is when these refunds end, which they will over the next few weeks, what happens going forward. The hope, obviously, is that we get some relief in terms of oil and gasoline prices, which might also then bring down interest rates. But if we don't see that, I think you will see a significant slowdown in discretionary consumer spending going forward.
Well, I mean, a minute ago, real quick on this, but a minute ago, you said that the trend has gone toward thinking about tightening. I mean, Kevin Warsh coming into the Federal Reserve, I think the last thing he wants to do is raise interest rates as his first move. So I suspect that's not going to happen. Your thoughts?
No, I totally agree. I'm just articulating what the market is pricing in.
Right.
They've gone from expecting rate cuts to hikes, which I think is staggering, and really a shot across the bow for those private credit borrowers who've been extending and pretending on the promise that rates would be lower. So this, if the markets continue to expect tightening, we're going to get some bumpy times for both credit and for equities.
Yeah, all right. We will leave it there. Stephanie, always a pleasure. Great to see you. Stephanie Pomboy joining us with a market that is near the highs of the morning after the data. Dow Industrials up 416, NASDAQ up 65 in record territory. We'll be right back with EPA Administrator Lee Zeldin. Stay with us.